SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF BAFFI BOCCONI E-Lecture on SME Financing key findings from the EIF's new European Small Business Finance Outlook 2021. When I saw this report on the internet and I opened it, I was immediately convinced that this is such a rich analysis that we must provide an opportunity for SUERF's audiences to learn more about it and to provide for an opportunity for other institutions also to get involved and discuss it. We are very happy and privileged today that Helmut Krämer-Eis, Frank Lang and Wouter Torfs from the European Investment Fund agreed to present some key findings from this report. Of course, it's not possible that we do justice to the entire report. The easiest way to get into this report is just to listen now to this webinar and to get the main ideas from it. Then we have three discussants from three major institutions who work on this issue. Rudy Aernoudt from the European Commission is going to bring in his institution's view. Lilas Demmou from the OECD will provide her insights. And Friederike Koehler-Geib from KfW Bankengruppe will also comment and bring in her perspectives. Without further ado, I hand over to Helmut, Frank and Wouter.
Many thanks, Ernest, for this kind introduction, and many thanks to you and your team for the invitation to present here elements of our 21 version of the regular small business finance outlook. It has even almost 200 pages, so really too much to present in total today. Just a few words about the European Investment Fund, the EIF, in order to explain why we are producing this report regularly and why it is structured in a certain way. And we are an EU body as EIF dedicated to improving access to finance for SME business, for small businesses. So focus on SMEs. We do not invest directly, but indirectly via financial intermediaries, and we are not a bank. So a focus on intermediaries. We use financial instruments like guarantees and equities to address gaps, foster sustainability, and to multiply resources. So it's a crowding in approach to catalyze private financing. So a focus on financial instruments. And we are part of EIB Group, and the EIB is our main shareholder. And in addition, we have as important shareholders the European Union, represented by the European Commission. And we are happy to have then later Rudy on board as a discussant from the side of the Commission. And we have as well a group of 38 public and private financial institutions from EU member states, the UK and Turkey as shareholders, with KfW being an important financial institution shareholder, and happy to have Fritzi here today as discussant as well. And of course, we are happy to have Lilas from the OECD to give the global perspective. We cover the entire range of development stages of companies with various products, starting from the pre-seed stage via the startup phases to the level of the matured SME. For example, we provide guarantees to banks, to guarantee schemes, or to microfinance providers. We provide equity to venture or mid-market funds, or we provide guarantees in the context of securitization transactions. And in order to support our activities and strategic development, we from the research side, we regularly look at these different markets using quantitative and qualitative approaches, as well as ex-ante and ex-post intervention perspectives. And one output is this regular European Small Business Finance Outlook, where we take a pan-European perspective, where we are looking at financial instruments of relevance to EIF, with a particular focus on financial intermediaries, but also, of course, not forgetting the what we call final beneficiaries of our support measures, so the small and medium-sized enterprises and small mid-caps. And in addition, we are looking more and more often at certain policy priorities and thematic objectives. And this is why the report is structured like this. And given the time limitation, we agreed with Ernest, you mentioned it in your introduction, to focus today only on three parts, namely the general SME financing environment, the European private equity market, and in particular venture capital, as well as on SME green financing and investment. These areas might not so well known to the audience, and therefore we go into the details of this. So now over to the content of the webinar. We mentioned the general environment for SME financing only very briefly here as an introduction, as we want to leave more room for the venture capital and green part. As I said, it's perhaps a more unknown territory for the audience. Let's simply look at a few results from the ECB's SAFE survey, the survey on SMEs' access to finance. During the immediate aftermath of the first pandemic outbreak, 1 in 3 European SMEs experienced severe access to finance issues, as you can see here in the top left graph. From the second half of 2020 onwards, concerns about access to finance declined as a whole, initially mainly for large firms, but most recently also for SMEs. And this recovery is inter alia driven by state aid, as indicated on the bottom left chart. The use of subsidized lending and grants spiked at the start of the pandemic in 2020 and remains elevated today. While issues are lower now today than they were before the COVID pandemic, 1 in 4 SMEs still consider access to finance to be a serious issue, indicating the structural nature of the overall issue. On the two charts on the right-hand side here, we see that for the same topic, there is quite some cross-country heterogeneity, with Greek SMEs continue to be the most pessimistic. Turning to the second level, during the onset of the pandemic, turning to the sector level, during the onset of the pandemic, there was clearly a difference between access to finance issues in the construction sector on the one hand, and services, industry, and trade on the other hand. Today, these differences have leveled out, and there is not much variety between sectors remaining. Overall, it's not here on the charts, and I don't want to go into details. So the economic recovery is widespread across firm sizes. Following a downward movement last year, SMEs' profitability and vulnerability indicators have now started to improve. And there is a moderate increase in demand for bank loans, and their availability is improving. And SMEs expect improvements in their external financing conditions. Turning back to the bottom left image here on the slide, it shows that the SME financing landscape, unsurprisingly, is dominated by bank lending. We know it. External equity is traditionally only used by a very small proportion of companies. However, this small group of venture-backed companies is economically very relevant, as these are typically highly innovative, high-growth enterprises and scale-ups. And therefore, we'll now take a closer look at this relevant market, and I hand over to my colleague Frank.
Many thanks, Helmut. Indeed, I will now present to you some information about the European private equity and venture capital market. And as Helmut said, compared to debt financing, private equity and venture capital are only a relatively small part of the SME financing markets in Europe, although a very important one. Because, as Helmut said, these instruments address young and innovative companies and companies with a substantial growth potential. It's also a very important part of EIF's business activities, which is why we also cover it in our European Small Business Finance Outlook to a larger extent. Later in this presentation, and also in the European Small Business Finance Outlook, you will hear and read a lot about the important topic of financing of green tech investments. And private equity and venture capital are indeed very important elements for the financing of such green tech investments. As you can see here in the slide, a healthy green tech sector, a healthy green tech ecosystem can only thrive in a well-developed private equity and venture capital environment. In the following, and in this slide here as well, I will now give you a brief overview of the European private equity market with a particular focus on venture capital. I will show you the market development, in particular during the COVID-19 crisis and current market challenges. In this slide, we see the overall European private equity market activity since 1997. Market activity means funds raised by European private equity funds It also means investments by those private equity funds into their investee companies and amounts divested by these funds. When looking at private equity overall and its development over the past 2 decades, we see that the European market has become much larger in terms of activity volumes. At its peak in 2019, European private equity fundraising stood at a level of 119 billion euros. In particular, after the great financial crisis, we had seen a strong market growth. However, what we also see is that the market had grown at even higher rates before the financial crisis and then crashed strongly, and market activity almost came back to the levels reached in the late 1990s. At the onset of the COVID crisis, there was then also a certain fear in the markets that something similar might happen again. The COVID crisis actually hit the European private equity market at a time when it had been on a relatively stable growth path since more than 10 years. However, compared to the financial crisis, and I will show you that in a second as well, with a focus on venture capital, both the private equity and the venture capital market weathered the COVID crisis quite well. In the next slide, you can see that this is particularly true for European venture capital. Venture capital is the segment of private equity that is most relevant for risk finance for young, innovative startups with high growth ambitions. What we see in this slide on the left-hand side is that VC fundraising decreased in the COVID year 2020, similar to what we've seen for private equity overall, but VC investments in Europe even exhibited further growth during the crisis year. There are several reasons for this relatively good performance of private equity overall, and in particular of venture capital. Compared to the financial crisis, the European venture capital market has had several additional years to get more developed and more mature. So there might indeed be a stronger crisis resilience in place compared to previous crises. But in addition, as we can see in the next slide, support by government agencies also played a role. What we see in this slide in the upper diagram is the share of different investor categories that invest in European venture capital funds. The pink line are government agencies. They are obviously one of the largest investors in European venture capital. What we can also see is that government agencies' shares in new funds raised by European VCs typically increases during and after crisis periods. This shows a certain countercyclical role that government agencies play in the market. So government agency support seems to have helped the market to stabilize during crisis periods in general and also in the COVID crisis. However, another reason why the COVID crisis had an effect on the venture capital market that was different from the financial crisis is that a substantial share of venture capitalists even benefited from the crisis. In the next slide, we see some results of our EIF Venture Capital Survey. The EFVC survey is a survey among VC fund managers in Europe, and to the best of our knowledge, this survey, together with our European Private Equity Mid-Market Survey, is the largest survey of VC and PE fund managers, at least in Europe. The 2021 wave of the EIFVC survey includes anonymized responses from 479 VC fund managers representing 379 VC firms. It includes EIF-supported fund managers and other VCs. The 2021 survey wave was performed in July, which is important for the assessment of the results that I will show you. The orange diagram here in the right-hand side corner of the slide shows VC fund managers' responses on the question, what sector would you consider as the most promising for VC investments in the near future? The font size represents the frequency of mentions of the respective answer in a free text response field. What we see is that many of these sectors that were frequently mentioned and in which VCs typically invest have actually benefited from the COVID crisis. For example, healthcare, life sciences, and investments in digitalization. Hence, not surprisingly, VCs are also confident in the long-term growth prospects of the VC industry in Europe. In the blue diagram here, you can see the results for our survey question about the respondents' confidence in the long-term growth prospects of the European VC industry. We can clearly see a strong rebound of the confidence following the initial crisis slump. However, despite this resilience of the VC market in Europe during the COVID crisis, there are still quite some challenges for European venture capital, as we can see in the next slide. What we see here is what our survey respondents perceived as their most important challenges. Obviously, the strong market recovery led to increased competition and, as a consequence, also to higher investee company valuations. These items were stated most frequently as an important challenge in our July survey this year. However, despite the strong market recovery, fundraising was stated to be a very important challenge as well. Of course, fundraising is always a challenge for fund managers, but Europe even lags behind other world regions, in particular the US, in terms of fundraising volumes, as we can see in the next slide. On the left-hand side, we see here absolute VC fundraising volumes for Europe in pink and for the US in blue. The right-hand side diagram uses the same color code for these two world regions, but shows VC fundraising as a share of GDP. We can see that Europe is indeed lagging behind the US in terms of VC fundraising, and we see some reasons for this in the next slide. What we see here is that this difference that I showed you before is partly driven by a substantially higher number of larger funds in the US than in Europe. In particular, for funds of a size of 500 million euros and above. So it's not so much the difference overall, which forms part of the picture, but it's in particular a difference at the larger fund sizes. What does this mean for European companies that are seeking to be financed by venture capital? In the next slide, we can see to a certain extent that non-European investors fill this void. This diagram shows you that the share of capital provided to high growth companies by non-European investors, which are represented by those parts of the bars that are not colored in pink here, that this share is particularly high in larger funding rounds. So in those columns at the right-hand side of the diagram, Indeed, as growth financing is not that well developed in Europe, many companies look for investors outside Europe for funding of a sufficient ticket size. This is also known as the phenomenon of a lack of scale-up financing in Europe that Helmut already mentioned at the beginning of the presentation. To summarize, in the next slide, the European private equity and venture capital market weathered the COVID-19 crisis relatively well, and at the same time, important challenges have nevertheless remained. In particular, as shown in terms of fundraising, scale-up financing, but also the exit markets and the market size compared to other world regions. Of course, you can find many more details in our publications. My colleague Wouter will now tell you what this all means for the financing of greentech in Europe, which is actually the core focus of the publication that was just published by SUERF on their website and of our presentation here.
Okay. Thanks, Frank, for the handover. So first, a few words on why we are talking here about green tech. And of course, what is green tech? So for our purpose here, we define it rather pragmatically, I think, like most people in the literature do so. So broadly speaking, green tech is technological innovation that aims to address an environmental issue. So in other words, green tech companies provide solutions that reduce the marginal cost of pollution reduction. So hopefully by now, whether or not the environment is a cause worth investing in is no longer something we need to debate without going into too much detail here, because it's definitely not my area of expertise. It's clear that the costs associated with this changing climate are huge. So over the past decade, as you see on the left-hand slide here, the total financial costs alone of weather-related disasters in Europe exceeded 100 billion euro. And it is only in the second half of the century that this true cost will start to emerge. Under business as usual scenario, a high emission scenario, these costs are truly astronomical. Some estimates have the cost of flooding alone in Europe at the end of this century, when the people that are now being born will still be alive, basically, at 5,000 billion euro per year, so every year. So I always feel like these numbers are so high that they are at risk of becoming a little bit too abstract to actually still have any meaning, any impact. But I think this summer, this all became very tangible here, very close to us in Belgium and Germany with the July floods. So it was painfully clear, I think, from the images what it means to have 30 billion euro of flood damages. So imagine multiplying the situation we saw times 100. So this rationale for investing in these measures that will prevent all these costs from actually happening, from materializing, I think it's obvious. And also the Commission realized this when they announced their very ambitious plan, the Green Deal, where we will commit to a 55% reduction in greenhouse gas emissions by 2030, among many other things, of course. Climate action is only a part of the package. So to reach this 55%, their models calculated that every year from now until 2030, more than 300 billion euro needs to be invested every year, in addition, on top of the business as usual scenario, into the European energy system. So I think you probably heard this 300 billion euro here and there, this investment estimate. It's been used quite a lot, different kinds of communication, different kinds of presentations. It stems from the models of E3. Perhaps someone in the audience is very familiar with those. However, when this 300 billion is cited, it's not always very clear what this refers to. So these are investments into our energy system, right? Both at the demand and the supply side. So it are mitigation investments. So yeah, basically measures to reduce greenhouse gases, gas emissions. So what these are not investments in green tech R&D. So rather what you could do is you could interpret these amounts as the future demand that will arise for green tech products. And this is where I want to get at now. I think what this illustrates is, aside from, that's a huge investment challenge awaits us, this green revolution can also be an opportunity. It's not just a cost, it's an opportunity. But in order to take advantage of this opportunity, I think it's of crucial importance that we properly develop the European green tech ecosystem so that it's competitive on global markets, so that it will be perhaps European companies that will be able to provide the eco solutions to the problems that await us now. So yeah, and at the same time, it's a win-win situation, because this green tech ecosystem can ensure we transition towards this net zero goal in the most cost-effective way possible. Since, as I mentioned before, eco-innovations by definition reduce the marginal cost of pollution abatement. So yeah, with that in mind, in the following slide, we'll take a closer look at the green tech sector in Europe. And we'll do this from a perspective that is most relevant to us by examining financing patterns. So yeah, what we did was we used the PitchBook data platform to extract information on investments received by companies that are headquartered in the EU. So to frame the investment magnitudes here a little bit, we consider only venture capital and private equity growth. We don't consider merger and acquisitions and buyout. Why? These are simply the markets most relevant to us as the European Investment Fund. And arguably, they're also the most relevant when you really want to talk about innovation financing. But it's only a fraction of the market, because obviously the buyout and the M&A markets are substantially larger still. So what you can see here on this slide, so the European, on the left-hand side, the European green tech sector has grown quite a bit since 2010. So in the beginning of the period considered here, annual investments into clean tech companies did not exceed 1 billion euro in Europe. 10 years later, only in the first 3 quarters of the current year, we are already at a level tenfold that amount. So apart from the exponential growth in investment volumes that is shown here, the figure is, I think, 2 other conclusions worth reiterating. First, there is a clear increase in scale. We measured scale by average deal size simply. The line graph you see in the chart, to be read on the right axis. It increased from about 2 million euro in the middle of this previous decade to 20 million euro today. So I think this is a clear sign of a market that is looking to scale up. The second conclusion worth mentioning is the exponential growth in the market actually set off only from 2018 onwards. In the beginning, it was a bit hesitant. So 2018, that's basically after the announcement of the Green Deal. So I think consistent with the very nature of environmental externalities, it seems that policy is driving the dynamics here. So an important implication of that is, if you want to predict in which sectors, in which green tech sectors, investment demand is likely to arise in the future, it might be a good idea to keep close track of policy plans. Turning to a sectoral perspective on the right-hand side, I think this conclusion is confirmed somehow. So we distinguish there between 4 different environmental targets that are embodied in the green tech company's business model. I won't go into too much detail on how we constructed these. It's not always easy because you cannot use traditional sectoral classifications. But what is clear from this graph is that there is a sharp rise in activity in energy generation and mobility applications. And I think it's not coincidental that this reflects the Commission's focus on climate issues in the Green Deal. I mean, the Green Deal is about more than that. It's about much more than climate. But we have to admit that the central focus is on climate action. It's probably also one of the more urgent things we need to address right now. So yeah, policy and regulation seem to be driving the investment decisions. What we can also see is that the circular economy sector is lagging a bit. So we distinguish between 4 sectors: the circular economy, energy, mobility, agri, and food tech. So the circular economy is lagging a bit, a tiny fraction of total green tech investments. So important here is to realize that the concept of circular economy, while intuitively very clear, it's not always equally well defined, I think. So the majority of the companies we found in the data were active in the field of waste management technology, mostly recycling, basically. I feel it's a bit of a missed opportunity, let's say, that this sector is lagging and this category remains underdeveloped. I think the circular economy sector has a huge potential to make a cross-sectoral impact, as we say. So to make this very concrete, take the building sector. An important element of the Green Deal is a modernization of Europe's building stock, the so-called renovation wave. Absolutely necessary. Heating is an important, the heating of buildings is an important contributor to European emissions. I think buildings make up between 10 and 20% of total emissions in most countries. But of course, the very act of renovating a building, which sometimes goes very close to demolishing it completely and building it from scratch, has a huge emission impact as well. So in the EU alone, 40% of the waste that was generated comes from the construction sector, 40%, almost half. And only 3% of building materials are currently recycled. So what I'm getting at here is that technological developments in the field of circular economy, meaning the reuse of materials, which can be quite technological, by the way, have the potential to actually reduce the footprint of other policy measures as well. So there are important interaction effects in trying to support this specific subsector. So yeah, it begs the question, why is this sector so underdeveloped if it's so important? Again, I'm circling back to this policy argument. Perhaps the policy framework is not as clear-cut as it is for climate. It's a bit of a vague concept, whereas policy directly related to climate action is much more tangible. People know what it is. People know what it is to use electric cars, to use heat pumps, whereas circular economy, perhaps that's something that is in need of some improvement. So yeah, for the time being, of course, these are all speculations, but we do have some projects in the pipeline that are looking to dig a bit deeper into the causes of the development of local ecosystems. So it will be exciting to see what comes out of there. So let's now have a look at how this green tech investment activity is spread out over Europe. So these maps here combine all investments from 2015 onwards, and is mapped out at the level of the country. So at the left-hand side, the bubbles show you the geographical distribution of number of deals. The color intensity, on the other hand, refers to total deal volumes. So you can see that green tech is everywhere, deals in nearly every EU member state. But it's also equally clear that not all national green tech markets are developed to the same extent. Major European green tech hubs, France, Germany, Netherlands, Sweden. These are not just scale effects, by the way. I did not add this to the slide, but if you rank green tech investments as a share of the total VC PE investment ecosystem, also these 4 countries come on top. So they actually do have an edge when it comes to green tech. It's not just because their markets are simply larger. It's also not just size in which countries differ. There's also significant differences in technological focus, and that you see on the right-hand side of this slide here. So the right map uses the classification system I touched upon earlier, and it shows the distribution of the total deal volume over 4 categories. So what we found was the French green tech market disproportionately focuses on agri-tech and food tech. For mobility solutions, you need to be in Sweden, and the German and the Irish market, for example, are much more focused on energy tech. So again, this begs the question, what's driving these differences? So it could be, one possible driving factor could be policy. And so it's well known, for example, that Sweden has been ahead of the curve when it comes to green mobility policy measures. This might be what incentivized Swedish green tech entrepreneurs to focus more on mobility. But it could also be, just looking at the graph, a country's emissions profile. For example, the German energy system has a relatively high emission intensity because it still has a relatively high reliance on fossil fuels today. So perhaps this is what drove German entrepreneurs to come up with solutions to address this problem. Another possible potential hypothesis you can derive from this map here is the cultural nature of a country. So, for example, the French have a cultural affinity for agriculture. Think wine production, a sector very sensitive to changing climate. So yeah, maybe that's the reason that the French ecosystem disproportionately focuses on agri-tech. Of course, again, all very interesting hypotheses. We all still need to test it formally. So hopefully our clean tech project that's in the pipeline will be able to provide at least some of the answers. So yeah, I think it's already time to conclude because our time slot is running out. So in general, I think it seems that the European VC sector managed to weather this crisis reasonably well, at least until now they did. So arguably, public support played a crucial role there, including many of the initiatives that we here at the EIF have deployed. Of course, there's also the fact that VC-backed companies, they live by the crisis as an opportunity mantra. So they provide innovative solutions to crisis situations like the one we're experiencing now. In that context, it's also not surprising that part of the bounce back of the VC industry was driven by sectors like healthcare and IT, two sectors that thrived during the pandemic, basically. So yeah, our very own VC survey brought to light that the outlook that's ahead of the sector seems also rather positive. So that's also definitely a bright spot. However, though, we need to warn that structural issues do remain. For example, as mentioned by both Frank and Helmut, the lagging European fundraising environment, the lack of scale in VC markets, which we touched upon as well. So these are two issues that could be particularly problematic, and I will circle back now to the green tech sector for the development of this green tech sector. So many green tech business models are what we would refer to as deep tech business models. So they run models that are business models that are relatively complex, very long, lengthy, costly R&D processes that require large upfront capital investments. And that capital needs to be, in addition to of sufficient scale, also patient enough to follow up all the way through the scaling up process. So that means from the very early development stages all the way up to commercialization of the resulting product. So we've showed that this is a potential problem in Europe when it comes to scaling up. So these large rounds very often are financed by foreign investors. You could wonder, is this necessarily a market failure? Perhaps not in the traditional sense of the word, but it's a direct consequence, I think, of a fragmented European market. And this situation risks losing control over a sector that might be of major strategic importance in the future. And it also risks missing out on this green opportunity, at least partly. So perhaps coordinating a European-wide approach to venture capital support in general and for green tech market support specifically could be a solution there. So, and the final point I want to make, final issue, I touched upon it earlier also, I think it's regulatory uncertainty in the green tech market today. So we all know the targets. However, what is not entirely clear is how these targets will be achieved. This is also because we are in the middle of a complex political reality with a lot of interaction between the national and the supranational levels. It is without a doubt that national climate plans will play a huge role in determining which policies will be put in place, and therefore also what type of green tech technologies that will be in high demand. But unfortunately, the national climate plans have been criticized for being rather vague on the specifics. So this could put private investors a little bit in a wait and see modus. So I think also here you could argue that there's scope for public financiers to step in and take part of the risk of this regulatory uncertainty upon them. So, and with this, I will give the floor back to Ernest. I thank you a lot for bearing with us here, and I hope you found it interesting.
Thank you very much, Helmut, Frank, and Wouter. I will now turn to Rudy as the first discussant. Rudy will, among other things, focus on a point just made at the end by Wouter on lagging European scale-up markets.
Indeed, I would mainly focus on the scale-up issue because, as you've seen, for green tech, scale-up is very important. And Helmut as well talked about the scale-up issue, and I think it's very important to look how it looks. And if you can be so kind to go to my next slide, Ernest. There you see, if you look to the ecosystem of Europe the last 10 years, 36% of the starters were European-based. So we could say that there's a good ecosystem for startups, including for financing. And I think everything which has been done, namely by the national promotion banks and by the European Investment Fund, by all the programs they manage, I would say that the startup gap is almost closed. Where you have the problem is the right side of my slide, which is unicorns, which you have 14 out of them. And this includes United Kingdom, which almost represent 50%. So the first conclusion is it's not about startup, it is about scale up. On the next slide, as you can see, if you ask companies what is the problem, and you see the first column is from the SAFE survey, You see that external finance for European startups, it's an issue, 69%, but it is even more an issue, third column, in the United States. When you look then to scale-ups, then you see the big difference. What is the problem for scale-ups? The second column, it's external finance and it is availability of staff. Compared to United States, we see that for them, scale-up financing is less important, and that's of course what we have seen in this marvelous study of the European Investment Fund as well. So it's about scale-ups, and let's look to scale-ups because that's in fact where we need to intervene. As you can see on the next slide, these are the slides which you have seen, in fact, about investments into European companies. We see, and this is perhaps not very normal, that on the right side, figure 2, which is from the EIF report, that you see that, in fact, startup seed financing is bigger than later stage financing. And I quoted the Financial Times of yesterday saying that now in Europe, 19% of all venture capital is startup Europe. So Europe is important in startup. And look to the left side, you see the red one. The red one is, in fact, Series D plus United States, which is bigger than the two blue ones, which is China and Europe. So again, everything goes into the same direction, that the big problem for the future will be the scale-up financing. Let's move to the next slide then. And that's in fact the slide which has been shown by Helmut. You see that the big funds in Europe the gap is widening. We have now 180 almost in the United States, 120 in Europe. And if you look to the big funds, and then I focus on the EIF 500 million funds, we have 48 in US, only 7 in Europe. If you look to the dry powder, it was estimated that the 15 biggest United States funds have 500 billion dry powder. This is more than the GDP of a country like Belgium. Let's move to the next one. What happens? We said until 2019, companies are moving to the United States to find money. And there was a study done by EIF a couple of years ago. 44% of the companies are moving in scale-up phase. What we see with COVID now is that capital becomes mobile. Look, in 2011, 10 years ago, there was 2.7 billion euro invested by US funds in European companies, mainly scale-ups. Now it's 50 billion. If you look to what capital has been raised in the COVID year 2020, 75% of all capital raising rounds, there were US funds involved. They were involved in 1,434 deals in 2021. In fact, what this means is that as the value, and we have seen in one of the slides of the European Investment Fund that the valuation is one of the big issues, but American companies or now American funds are now willing to pay a higher multiple. And that's why, in fact, if they are in competition with European VC funds, mostly it's the American VC funds who, in fact, do the deal. And most of you know some examples. So we have two phenomena. Scale-up gap is widening in Europe. And secondly, based on evaluation, we see that US funds are coming to invest into Europe. Next slide. This is the slide, in fact, that has been shown by the EIF, saying that this is positive and negative. What is positive, in my view, is that the government agencies, the highest one, is slightly anti-cyclical, which is very good. But at the second point, if you see that 30% of the venture capital fund world in Europe is government money, we can wonder if that is not too much, if the 30% is not something that should go down, especially when the figures of the market are relatively good in general. So what should we do? And that we can see on the next slide. What happens now and what the European Fund is doing until now, and most national promotion banks, is co-investing in equity. And this, I think, was the main reason that the startup gap has been closed, because EIF, let's say BPI France, etc., they're all in these funds, and that's why we find money for startups. Now, the next step is, if you look to, we have equity, at the same time, there's too much public, we should try to find other ways. And the other ways is one you find in the next slide, where you see that, in fact, the idea is that we try to move to funds that, in fact, on top of equity, they would have quasi-equity. And this is a pilot scheme which has been run by the EIF last year. It's called Escalar. It's inspired by, for those who know the United States SBIC system, where in fact on top of equity, you double the investment capacity by quasi equity. What is quasi equity? It means that the return is capped, but the risk is limited. So the idea is in fact that on term, we would be capable to trigger private investments, such like pension funds, into the venture capital world, just like the Americans do. And if we do that, that should be, of course, perfect. Let's move to my last slide. It is not what the fund is doing now or Escalar. It should be both. It should be, on the one hand, pari passu, which is what we're doing now. But of course, we should be careful not to have too much money. And then if you click once more, you see that, in fact, click once more. We have, in fact, two types of share classes. We have the equity ones, which are still there and which you can still do. And on top of that, we would have the Escalar shares to do it. And in fact, with Escalar, we can double the funds. And if the funds are bigger, taking the rule that I can put 10% in one investee, this would be, in my view, the best way to cope with the Scaleup Gap. Escalar, which was a pilot project in 2020, will now be integrated in InvestEU for the next years. So my conclusion is, let's really focus now on the scale-up, because this is where the problem for Europe is. Thank you for attention.
I cannot agree more. So you made the analysis of the scale-up issue. We mentioned it in our presentation as well. So we clearly see the scale-up gap, a gap driven by the lack of European investors, the lack of bigger funds, the lack of crossover funds that invest pre and post IPO, and the like. And in general, we indeed need more European long-term institutional capital in the market. For example, I looked at the latest Atomico report this week, and it showed that European pension funds allocated in 2020 only $700 million to the venture capital market. This is just 0.018% of their total assets under management. And there are, of course, regulatory limitations like Solvency II and the like, and there are needs for improvements. So in general, there is room for more investments. And that's why we as EIF also offer such players like insurance companies, pension funds, and the like to invest via us, via an asset management umbrella fund structure to invest into the market. And overall, this raises different types of concerns, like the risk of foreign relocation of companies, brain drain, tech leadership and sovereignty, etc. And in fact, research shows that entrepreneurs supported by foreign VC investors are more likely to experience a foreign exit or IPO. And that many venture-backed European startups that exited via mergers and acquisitions were acquired by non-European buyers, in particular from the US and Asia. But on the other hand as well, cross-border investment flows demonstrate also the internationalization and development of a European tech investment landscape, and is of course as well a positive sign also regarding the attractiveness of the market. It is in general a question of how to mitigate the negative spillovers, and how much relocation finally happens is also a function of the strength of the domestic ecosystem. In a stronger domestic ecosystem, local entrepreneurs have fewer reasons to leave, in fact, more reasons to return even. And that's why an initiative like the Escalar initiative is so important. And Rudy mentioned it, there was a pilot project that was successful, and it's going to be continued under InvestEU, which is a very good approach. In our presentation, Frank had mentioned our VC survey, and we had as one pillar in the survey recently as well questions around how the VC funds they themselves see the scale-up issue. Maybe Frank wants to say something very briefly about that.
Thank you, Helmut. Yes, indeed, VC fund managers also confirmed at all stages, basically, that there is a lack of scale-up financing in Europe. So we saw that also in our private equity mid-market survey, but also in the venture capital survey, and perhaps also interesting and a bit linked to what Helmut just said. In a previous survey wave, we also asked what are the elements that are missing the most in the European venture capital ecosystem, and what was the element that was most frequently mentioned that is missing. That was the involvement of pension funds as an investor and the readiness of large private institutional investors to invest into European venture capital, which is of course closely linked to the issues that were mentioned in the presentations, meaning relative lack of large scale funds in Europe compared to the US, for example, and the missing scale-up financing. So I think this is one element that could perhaps improve the scale-up financing, the support for the scale-up financing gap. Another element is the relatively underdeveloped exit environment and the IPO market in Europe, which is of course also a way of creating additional finance for companies to scale up and to grow.
Thank you, Helmut and Frank. I think it's now time for Lilas to come in.
Good afternoon, everyone. Thank you for the invitation. It's my great pleasure to be there. And thank you to the authors also for a very nice presentation and a great report. I mean, as it has been mentioned, it's a very rich report. It covers several very important issues. From that, you can have a very comprehensive picture of the evolution of financing conditions for SMEs, touching on very important issues such as financing for startups, green financing, and so on. So a document which will be very useful for us. On my side, I would like to build on this insight and but to focus on the change in the financing condition of SMEs during the pandemic, which are well described in the report, and to discuss the potential consequences of this change for the recovery and for medium-term productivity. So let's start by a positive note. So I think I haven't still got my red one. It's okay. So let's start by a positive note. So with what has been achieved so far, with the widespread policy intervention and the associated improvement in financing conditions for SME. So such intervention have actually protected SMEs from two major risks. One is the risk of a widespread liquidity crisis, well documented already, and another one is the risk of an adverse market selection mechanism. So, looking at the liquidity crisis, you can see in this slide our calculation regarding the share of firms facing liquidity shortfalls under different scenarios. So here we use a micro simulation model and we cover about 1 million of European SMEs. And what you can see from there is that without policy intervention, the financial, the SMEs landscape would have been very much affected by the crisis, with about 30% of SMEs facing liquidity shortfall. And this number masks strong heterogeneity. Policy interventions, which is the access to liquidity, and including by the use of debt instruments, have contributed to bring back this share toward the level observed in normal time. So in other words, it contributed to somehow hibernating the corporate sector. And this hibernation strategy contributed to keep the bankruptcy rate under control, and even more, you can see that the bankruptcy rate declined compared to normal time. And this decline raises a first important question, which is to what extent the hibernation strategy have led to support too much unproductive SMEs, generating potentially some scaring effect for productivity in the medium term. So to explore that question, what we did is to look at the link between the predicted liquidity status of the firm and its productivity. And we calculate, so, the probability to become illiquid at different level of productivity. This is the result are reported in that figure. So if you compare here the blue line and the red line, basically this allows you to compare normal time in blue and an hypothetical scenario without policy intervention. And without policy intervention, the probability to become illiquid would have increased strongly over the whole productivity distribution, and especially so for high productive firms. So this provides indirect evidence of an adverse market selection mechanism. And the policies have contributed to repair this adverse market selection mechanism by bringing the probability to become liquid close to normal time. You can see that for high productive firms. You can see that in the right. This is achieved at the cost of overhelping slightly low productive firms, that you can see in the left, where the probability to become illiquid is now lower than in normal time for low productive firms. However, additional calculation shows that the support to zombie firm has been broadly limited. So overall, this first exercise suggests that the hibernation strategy and the policies aimed at improving financing conditions of SMEs have been effective so far, but remains another question, which is what could be their impact on the medium term. And here we see two major risks, a risk of misallocation and a risk of debt overhang. So why those two risks? So first of all, because when you start to implement at a large scale some policy package, you run the risk of distorting the allocation of resources across firms. And if you take the case of loan guarantees, which have massively increased during the pandemic, one question is to what extent this could distort the allocation of credit across firms. So second, the use of debt instruments during the pandemic has increased the indebtedness of firms to its highest level since the 2008 crisis. And this also raises another question, which is to what extent firms will be able to operate normally after the crisis with a higher level of indebtedness. So to explore the question of misallocation, what we did is to use historical data on loan guarantee, and we estimate whether loan guarantee could alter the productivity enhancing reallocation. So our results suggest that on average, increasing loan guarantee program is associated with a lower ability of firms to attract more resources and to grow larger. For instance, here in that figure, we illustrate our result, and we show that an increase in the loan to GDP program by 1 percentage point is associated with a decline of the efficiency of resource allocation by 10%. So importantly, this is an average number which masks important heterogeneity. So we found, for instance, that the program could be even effective at boosting the efficiency of resource allocation for small scale schemes. And we also find more benign effect in intangible intensive sectors where firms are more financially constrained. So overall, this exercise points to the following. There might be risk in keeping this program at large scale, but the extent of the risk will depend also on the design and on which type of firms benefit from it. So let's now turn to our last point on the risk that over-indebtedness could pose for SMEs investment in the post-crisis period. Here, to illustrate the issue, what we did here is to calculate, do a very simple calculation. We calculate the number of years that is needed for a median profitability firm to repay a new debt, considering different level of debt increase, which are reported here in different color, 5%, 50%, and 25% of turnover, and assuming that the firms return to the level of profit which is observed before the crisis. And what this figure suggests is that in firms, SMEs in most its sectors might face more difficulties to repay this additional debt for two reasons, because they may have relied more on credit guarantee programs, and so they will likely be more in the gray or orange bar. And also, sectors present relatively lower profitability, which make even more difficult to repay the new debt. So if SMEs have to spend a lot of resources to repay this debt, they will certainly have less resources to invest. And we explore that issue also using micro-simulation model. So what we did is with this micro-simulation model, we estimate what would be likely the rise of debt for the median firm. And then we use historical data to calculate the link between investment and leverage ratio. And the result suggests that the investment post-crisis could decline substantially. We find it a -2 percentage point decline in investment ratio. So overall, what this different exercise suggests is that the policies which have improved financing conditions of SMEs during the pandemic were absolutely necessary, very effective in the short term, but they are also associated with some risk of misallocation and debt overhang. And now to lighten the load, let's say, for SMEs and strengthening the recovery, it is necessary to for policymakers to focus on these two challenges, to preserve what has been achieved so far, but also reduce the risk for the future. So we have identified a set of policies where one of the most important points is the debt restructuring, obviously, and also how to adjust the policy package for the new challenges as we exit from the crisis. I'm not going to enter into the details as I think I have exhausted my time, but I will be happy to provide more detail if needed during the discussion. I would like to thank you very much for your attention, and thanks again for a great report.
Thank you, Lilas, for these very important points. I take along, among many other things, that COVID government aid helped companies to hibernate successfully. But at the same time, it actually entails a large debt overhang now, and it risks to cause a drag on growth, and now needs to be accompanied by appropriate structural policies in order to allow the restructuring of the economy. So again, I give back the word to Helmut, Frank, and Wouter to immediately react to these comments.
Thank you, Ernest, and many thanks, Lilas, for these very interesting and complementary perspectives, complementary to what we said before. And yeah, as Ernest said, I have the same take on what you said, and you mentioned as well that the design of the instrument is important, that the sensitive withdrawal of the instrument is key. And also that equity type support or quasi equity type support will become more important. I can only agree to these points. Just to complement to this, we had as well a look at the guarantee instruments of the past. Of course, it is now too early to do an in-depth analysis of the crisis instrument already now, because the data is not yet available, but we had a look at similar instruments of the past that were applied during the crisis. And we analyzed around 360,000 guaranteed loans that were issued with our guarantees in the past under the MAP and SIP program. And we looked at France, Italy, the Nordics, Benelux, and Central and Eastern Europe with a very detailed and in-depth counterfactual approach. And we indeed found that the guarantee as a tool, they really work and add value. And after receiving a guaranteed loan, beneficiaries grew more rapidly than non-beneficiaries in terms of total assets, sales, and employment. And firms were also less likely to go bankrupt. So credit guarantees caused a decrease in bankruptcy rates of about 1/3 and up to a half in some countries. But the magnitude of the additionality of these effects of the loans varies quite considerably according to the characteristics of the beneficiary firms. So guaranteed loans have larger positive effects on smaller and on younger companies, and also the industrial landscape plays, of course, a role. So there are firm-specific and country-specific effects. What we found as well was that guaranteed loans have no significant treatment effect on firm-specific profitability. In the first 5 years of the loan received, the estimated treatment effect on productivity points to a short-term dip for treated firms, followed by a medium-run recovery and a positive long-term effect on the productivity of the guaranteed firms. So basically, first, the companies, they get the loan, the guaranteed loan, they invest, they buy machines and the like. Productivity goes down first, and then there is a catch-up effect over time. But that's, of course, a different profitability and productivity effect than you were analyzing. That's clear. Regarding the over-indebtedness, also there I can only agree it is an issue, although the SAFE survey shows that there is a certain relaxation in terms of profitability and vulnerability currently. But indeed, there is an increased indebtedness, but also there significant cross-country heterogeneity. And there are often calls for further equity and quasi-equity support measures, but that's often as well an issue because many companies are simply no target for the typical equity investors. And during the crisis, some people were even asking for helicopter money in terms of equity, which in my opinion can of course not be the solution. And AFMA, the Capital Market Association, published this year a report which estimated that Europe could face a funding gap of 450 to 600 billion euros in equity and hybrid capital to prevent business defaults, which shows the magnitude of the potential problem. So overall, many thanks for the comments. Very welcome. No disagreement on my side. I think, Wouter, you wanted to make a brief comment as well?
Yeah, not too much to add here. I mean, your point about a very interesting study, by the way. So the point about the inefficient allocation of labor, it's well taken, a valid one, hard to argue. I think in part because of the massive scale, the massive rollout of all these COVID guarantees, it must be inevitable that some of these zombie firms must have been created. Well, of course, at the time, the urgency of the situation, when all these support measures were being launched, we can, I think, also agree that putting in place a proper vetting mechanisms that would have prior, a priori, been able to pick out the winners and the losers, if it was at all possible, it would have been extremely costly, not in the least in terms of timing. So yeah, this temporary misallocation, perhaps it's a price we have to pay to avoid complete disaster. But I also think the issue of misallocation, as you mentioned yourself, will solve itself in the long run. Firms that will go insolvent eventually will shed the labor. This labor will be reallocated to more productive firms. You know, shown Peter in action with some delay. So yeah, I also want to reiterate the point you already made, that it will be absolutely key to phase out these support programs that are in place slowly and gradually. So yeah, perhaps it will lead to the inevitable situation that some of these SMEs will file for insolvencies, the ones that were not in the best state prior to the pandemic. But if the phasing out process is gradual enough. I don't think this needs to be too disruptive. But yeah, we need studies like this to point out that these things are currently happening, and we should be careful on the road ahead. So thank you for that.
Helmut and Wouter. We now turn to Fritzi for the final discussion.
Thank you very much for the invitation to this very interesting webinar. It's very nice to be in this round, not last because Helmut and Frank are former KfW colleagues. And I very much appreciate the international perspective of this report. And we had a couple of times when we talked about country heterogeneity and different experiences across Europe. And I'd like to take you now and take a look at the German experience during this crisis and complement the findings of the report, going more in depth on Germany. And I'd like to do this adding 3 points, and we see them on the next slide. First point, German SMEs. That's what I'll focus on first, the financing environment. In light of the twin transformation, the decrease in borrowing that we've seen during the crisis due to investment restraint poses a challenge. Second point, also taking a look at the German VC market now, we do see that the market, after initial dip in the crisis, is still on an upswing. The business climate and also the deal volume is extremely strong, and they are at record highs also in the third quarter of this year. Although the German market, and we've seen that before, applies also to the European market, is smaller than benchmark markets. And then third point, looking into the green transformation in 2020, and that's a study that we've just published today, German small and medium-sized enterprises have invested 22 billion euro in climate protection. And if we wanted to drive up this volume, and the transformation actually requires it, then we would actually need a more climate-friendly environment, and we would need to have more transparency about the climate-relevant properties of the projects that the investments do. So with this, I come to the first message on the overall financing environment of small and medium-sized enterprises. And at the next slide, we do see that because profitability in German small and medium-sized enterprises kept up very well during the crisis, and I find very indicative that already in April, 43% of SMEs had already adapted their business model or their product palette. Equity ratios, which we see on the right, have also only diminished very moderately. They were at very high rates in 2019, 32% almost on average for the SME sector, and it went down to a bit over 30%. That's still a very high ratio. However, and that we see on the next slide, the crisis has exacerbated the trend of downward corporate investment in Germany. You see that very clearly on the left. It's not so surprising that during the crisis this has happened. In one of our real-time surveys during the crisis, we asked companies about their business expectations and then basically linked that with the share of SME that were investing. And we did find that among those companies that have optimistic business expectations, a much larger share do invest than for companies with a neutral or a pessimistic outlook. You see that in the three upper bars on the right-hand side. So now in an environment where we have historically high uncertainty, as in the COVID crisis, of course, this is not so surprising. and basically explains also why we've seen this further exacerbation of the downward trend. The financing conditions, however, and that we see on the next slide, have remained favorable. But the volume of bank loans for SME have decreased considerably, mainly because companies were relatively reluctant to invest in this environment, as we have seen before. We see on the left-hand side that the share of companies for which all negotiations failed increased only slightly. We see that in a light blue line in the bottom, from 12 to 14% in 2014, and the share of companies for which all negotiations were successful, loan negotiations, decreased only slightly by 1 percentage point. Overall, we did see a quite substantive reduction in the volume, the average volume of bank loans. They basically dropped by 27%. And it's quite interesting. We've seen that a lot of companies have invested, but they have invested much lesser volumes that they previously did. And I want to stress this because we do see less in Germany a risk of over-indebtedness, as we have heard for other countries. But of course, when we think of the transformation, these small investment projects are a challenge because they are not those that we need for the transformation. And with this, I'd like to come to the point on the VC market to complement what we heard on that one from Helmut, Frank, and Wouter before. When we look into the German VC market, and we see that on the next slide, we are seeing a picture where we had a significant drop in the beginning of the crisis of business climate, and then a tremendous recovery. We see that on the left. And basically the business climate is at record highs. And this is a lot driven by the fundraising environment. What's quite interesting is that exit opportunities are seen critically, and this is mostly driven by the assessment of trade sales. This is mainly due to the fact that right now we have small and medium-sized enterprises that are the counterparts in those deals that are hit by supply bottlenecks, and basically that are hit by the new uncertainty about Omicron and the economic outlook. So we do see a respike, if you wish, a rebound of uncertainty right now, and this basically impacts here the business environment in this area. This doesn't change anything about the really strong volumes that we are currently seeing in the market. We see that in the next slide. We have seen in the past few quarters deal volumina that we've previously only seen in entire years. So the deal volume of 3.4 billion euro is almost as high as the 3.6 billion that we've seen in 2017. And the volumes were even higher in Q2. And on the right-hand side, you do see that those record highs would still apply if we take out mega deals, yet of course at a different level. And you may remember the names of the biggest deals that we have seen, be it in Q3, Gorillas Technology, or be it Celonis, for example, that was in Q2. And it's as we've heard before. Now these are very big deals. I think this is a very good sign for the German VC ecosystem. Yet there are foreign investors involved, no? And we've heard about possible implications of that. What's also interesting, and we see that on the next slide, so we saw this really important developments in the German market, and this slide then reveals, despite this dynamism, the German VC market still does lag behind other international markets, and we do see this picture that Europe lags behind the US. What I wanted to add there, though, is that, of course, we do have a much more bank-based financial system, which, of course, doesn't help us, though, for particularly innovative companies. And with this, I'd like to come to the third point I wanted to make about green investments, and that if we wanted to change anything about this downward trend, we need a more investment-friendly climate. In our small and medium-sized enterprise panel, we basically ask companies how much they invest in climate protection. And we see on the next slide that it's actually 12% of the companies that have already done so. That's on the left side, the first two bars. And 13% are planning to do so within the next year. And these 25% of companies have, the 12% of companies have basically spent a volume of 22 billion euro in climate protection. And you could see this glass is half full or half empty. If you think of the challenge ahead, this, of course, still is not enough. And if we wanted to change this, I think we really have to work, and we see this in the next slide, on the regulatory framework. There is a need to generate more transparency about climate-relevant properties and risks of investment projects. And I think here standards, of course, are an important feature. Of course, they need to strike a balance between the need of data provision versus the practicability from a firm perspective. And then, of course, there's a need for further access to capital market financing, and then public investment and technology promotion as leverage. And I'd like to leave it here.
Thank you very much, Fritzi. This was very interesting. On the one hand, we learned a lot about Europe's largest economy and equity financing, venture financing there, and recent tendencies. On the other hand, I think also your points in the last slides about needed institutional regulatory changes were quite interesting. Maybe Helmut, Frank, and Wouter, you want to comment, particularly maybe on these last points.
Yeah, thank you, Ernest, and many thanks, Fritzi, for this national perspectives. Very, very interesting indeed. I'll just make a brief comment on the venture capital part. Indeed, it is a very promising venture capital ecosystem. You described it. And I fully agree to this. With booming hubs, venture capital is not a national activity. It's often an activity that happens in hubs. So in particular, Berlin and Munich are very, very active in Germany in that respect. And also, you mentioned that the large deals among the top 10 European large deals. There were 4 deals in Germany. You mentioned the Celonis, the Gorillas. There are others like the N26 and others. So very successful in that regard. And also the among the top VC-backed exits in Europe, even considering UK as being a Europe, there is a German deal on the top with the Auto One Group. So overall, a very, very booming market. Also very active government support via the EIF, now as well via the KfW. capital also often now happening very jointly. There is the ERP fund of funds, the ERP growth facility, the mezzanine fund of fund. During the crisis, there was the Corona and is the Corona matching facility, also very important instrument. And now under this 10 billion German future fund, there is as well a growth facility supporting the growth and later stage ecosystem. Very important, these measures to continue the success of the German market. You mentioned as well that compared to other peers, Germany is still running a bit behind. Also, they're fully agreed. The German venture capital industry still accounts for only a tiny portion of the economic activity. It's 0.05% of GDP is the venture capital market. So there is still a lot of room. And also this links to aspects that we had before with the scale-up issue and the like. You mentioned the record volumes and venture capital activity in the German market this year. According to the latest PitchBook data, startups raised a record of 11.3 billion in venture capital funding in the first 3 quarters this year. That is 70% higher from last year's total. So impressive increase, but still in relative terms, we see the low levels and the potential that is still there. And the rise was driven by an increase in late stage capital. We mentioned the bigger deals. But the largest rounds of these deals, they did not see local backers. So then we are back to the initial discussion of the scale-up issue and the like, that there is a lack of really European investors in the market. So I think I'll leave it at that. And I'm looking at my colleagues, Frank and Wouter, if you would like to say something in addition.
I'll pick up on Fritz's point about the need for additional transparency. I think, yeah, we fully agree this will be key in the years ahead, but it's certainly a challenge, especially for institutes like the European Investment Fund and KfW. Public institutes, we will be required, well, to report to the public, of course, at some point. When we say we go green, we better also show we go green. And given that we run an intermediate business model, this is quite challenging. Of course, there's different types of challenges also. We need to be able to identify what investments are green, what investments are not. The entire discussion of the EU taxonomy that's going on right now. It's not particularly applicable to an intermediate business model because it's very much project oriented. It identifies projects as being green, but okay, what do you do if you give a general loan to SMEs? And well, especially what do you do if you don't give it directly, but through another intermediated business model? So yeah, we do have to put in place reporting mechanisms that work with our intermediated business model, and we are working hard on that. So yeah, without a doubt, we need more transparency. But as you said before, we need climate-friendly investments, but we also need an investment-friendly climate. So what we need to ensure is that these administrative burdens don't become too large, so that we continue to lock in the private sector in this entire story. Because, well, if they bail out, it's going to be very difficult to reach the targets. So it's a fine line to tread, a difficult balance to keep, but yeah, a very valid point indeed.
Maybe I can add a small point on marketing also for our publications. So Wouter mentioned transparency, and Fritzi as well, is important for climate-related investments in the market. And we did recently a survey of VC fund managers, also private equity fund managers, of climate-related considerations in their investments, to what extent it plays a role. We will publish the related results in early next year. But what we already saw in a previous survey wave, where we asked similar questions more generally on ESG, not focused on climate, but generally on ESG, we saw that in particular VC fund managers said in case they are not considering ESG criteria, it is because there's on the one hand a difficulty in quantifying such criteria, and second point that was actually the most important point for them is that in particular the smaller fund managers often have only limited internal resources and expertise to look into such issues, and I would expect that we will to a certain extent receive similar results for the climate related considerations in our survey. So we are very keen on looking into these results, and we'll publish that, as said, in due course in 2021. So, but definitely this confirms the important considerations about transparency for such investments.
This concludes our SUERF BAFFI BOCCONI webinar. Thanks a lot to Helmut, Frank, and Wouter for presenting your report, for sharing your insights with us, and to Fritzi, Lilas, and Rudy for your thoughtful discussion. Thanks to all of you for your interest. We hope to see many of you again next year. Already now, I wish you a Merry Christmas, a Happy New Year. Take care and bye-bye. Thank you.
Thank
Bye.
you.
Thanks a
Bye.
lot.
Have a good
Same to
day.
you.
Thank
And thank you
you.
to SUERF.
Thank you. Goodbye. Thanks a lot.
Bye-bye.
Bye-bye.
Bye.